And while January began with a weaker than expected 143,000 jobs added, the headline number, data revisions confirmed that hiring was strong at the end of 2024. The number of new jobs created in December was revised to the upside there from a previous 256,000. And November's employment increase was also lifted to 261,000, up from 212,000. Here to continue our coverage of that jobs report, we want to bring in Joe Brusuelas. He's RSM's chief economist. And Joe, it's great to have you here on set. There's a lot to unpack in this report, but you brought up something in the break that I thought was very interesting here, and that's the household survey, just in terms of what we are seeing there. Walk us through the significance of this and what this signals, what this tells us about where we are.
For the entire year of 2024, the haters just attacked every month that we saw job gains because it just couldn't be true. Look at the household survey. It's not moving. There's a divergence. Well, the population adjustment made by the BLS corrected that, guess what, in favor of the establishment. There was an additional 2.194 million people working last year, according to the household. A lot of that does have to do with immigration. But what that means is we got a bigger labor force. That's a good thing. You know why? It means we got a greater pool of labor to draw upon. That means there's going to be less wage pressure. As you unpack this, what you're going to see is people are going to start making a reassessment of that September rate cut by the Fed, the one that everybody, craps on. No, actually, that looks pretty good in retrospect right now, is we got disinflation moving through the economy via the wage channel. Even with that 4.1% increase year over year today, this is aligned with what we're seeing in the employment cost index, which is the metric the Fed uses to make policy anyways. So, I like what I see in that revision. Now, on the establishment side, it was much smaller than what we had thought, was 589, right? What that means is instead of increasing at 186,000 per month last year, we increased at 166,000, just a moderately slower pace. So this really does look good. And by the way, the January jobs report, once you took into account the December revisions, total change in employment was 194. Our forecast was 185. 2 months, you got an additional 100. Hey guys, this is a nice, solid demand for labor. I mean, there's really nothing not to like here.
So with that in mind, and the Fed's evaluation, because it wasn't expected that there would be any major decision coming off of this print particularly, but what are they going to be looking for, especially as the economy ingests policy decision making from the White House, from Congress, going forward from this juncture?
Two things, two levels. First thing is, we need to see rents ease. Second, service inflation is just stubborn and sticky. That's the thing you worry about if you're a central banker. And they outlined that when it was very clear that we were having a pandemic-induced price shock because we shut down the supply chains. Sure enough, it's manifested itself. Okay, the second level, it's trade and it's immigration. Now, my sense here is that the administration wants to provide a pretty big tax cut. I mean, when you add everything up, it looks like it's over $6 trillion over 10 years, right? They're going to need some offsets. They're going to, it looks to me, move to either ask for a border adjustment tax, which they asked for in 2017, which is perfectly legal under existing international treaties. Lots of countries have it. We just don't. Okay. If they can't get the votes for that, then I would expect they're going to impose a universal tariff somewhere between 10 and 15%. They need those revenues to be scored properly so they could get their tax cut. It's a movement in two parts. Second portion, immigration. Now, that's a much bigger deal. We need to think this through, because putting additional constraints on the labor supply, which we know growth is slowing, and by 2033 we'll move in the negative terrain. We got to talk about this, because that could cause some issues.
What could that look like?
All right, well, right now they're starting to deport people, mostly who've committed crimes. Okay, that's fine. All administrations do that. I don't see that being a big deal. If we get the first use of reconciliation mid-year to address defense, energy, and immigration, then they will have budget. Then second half, late this year and then early next year, you could see a stepped up pace of immigrations that result in a real constraint put on labor force growth at a time. And it's the internal inconsistencies in the Trump policy framework, right? They want to have greater than 3% growth, but to need that, you need close to 1% growth in the labor supply. They're going to be removing supply from the labor force. So they have to reconcile that. If you're an investor, that inconsistency can't go on for much longer.
And so, as an investor, if you are kind of looking through these revisions, looking at the new baseline, I say, or that we've been talking about that has been set, what should you be kind of evaluating as you've had everything from DeepSeek rattle the markets earlier this week, all the way through to tariff activity be some of the larger considerations? Where do you kind of prioritize what could really play out over the coming weeks, months here, even as more policy decisions?
All right, well, for today in the report, I think it's favorable to risk assets.
Okay.
That's why you see yields going up, investors and traders are moving from bonds over into more risky assets and equities. Okay. We're going to get a pretty big tax cut, it looks like to me. It looks like we're going to have a pretty aggressive deregulatory agenda. It's very clear to me what that favors, right?
Yeah.
Finance, banks, private equity, private credit. What's going on in AI despite DeepSeek? I looked at the expected outlay on CapEx. Over the next 2 years, it's $750 billion. DeepSeek's not going to disturb that.
Right.
So you want to be thinking about AI data centers and AI energy infrastructure. I personally think the feedback loop into energy is, well, how are we going to do this? Natural gas is going to get very favorable, right? I mean, that seems to me is not only it's the bridge for the next 50 years, but we're going to need that now to basically support the energy needs of the emerging AI industry. So this is all pretty favorable, if you ask me, towards risk assets, right?
Very interesting. Joe, it's always great to have you on set, especially on the day like today. Thanks so much.